Hello folks, welcome to this short video where we're going to talk about the capital asset pricing model, CAPM for short. You would have come across a reading in the material that is called "What is your real cost of capital?" And you may have noticed that this article was written in 2002, so it's coming up for being nearly 20 years old. It turns out that many of the finance principles that we talk about have been around for a lot longer than 20 years, in some cases back to the 1960s. So CAPM is part of the furniture, you might say, when it comes to using models in finance. And CAPM was originally designed to be able to quantify the cost of equity. Okay, so cost of equity is just a terminology we use to say the expectations that the shareholders have. Now, no doubt you have read this article, but I am going to just point out one or two areas that I think are important here. And we can come here where it says the standard formula for estimating the cost of equity capital, or depending on our perspective, an investor's required rate of return on equity, is the capital asset pricing model. The formula, which has remained fundamentally unchanged for almost 4 decades, states that the cost of capital is equal to the risk-free rate of the return, typically a yield on a 10-year treasury bond, plus a premium to reflect the extra risk of investment in question. The premium is the historical difference between the risk-free rate and the rate of return on the stock market as a whole. And of course, this article is American, so it is using the S&P 500 as the measurement for the market as a whole. We're going to use the all-share index. Then this calculation is multiplied by a number that reflects the volatility of the stock and the degree to which it has historically moved up and down with the market. All right, that is referred to as beta. Here we go. Adjusting the number is called the stock's beta. So in a moment, I'm going to bring in my spreadsheet, and we're going to talk about where some of this data comes from in the South African market and how we put these numbers together in order to do a calculation. All right, it is important to know that a little bit further down here, it says the adjusting number is called the beta and is calculated, and its calculation has long been a source of frustration. The message that we hear repeated by hundreds of conversations with corporate executives and investment bankers is that they fudge their estimates of beta because their experience and intuition tells them that beta is an unreliable measure of stock riskiness. Right, so there's this problem with beta, it's unreliable, and the assumptions that are originally made in order to come up with a CAPM mostly don't apply to single businesses. So CAPM was designed for a portfolio, and if you added a stock on the margin to the portfolio, measured the risk, it wasn't designed to be used for a single stock. So it doesn't work well. And so far, we haven't covered this in much detail, but it's important that we do at least touch on it, and we're aware that this thing exists, because when you go out into the world, you'll find that many people are still using this concept of beta and the capital asset pricing model. Okay, so let me bring into screen here. There we go, my spreadsheet that is labeled CAPM and has a few components in it. So it starts off with a risk-free rate, and we're going to use 8%. Okay, so where does the risk-free rate of 8% come from? It comes from The article referred to a 10-year government bond. In this case, I'm using a 20-year government bond, and there's very little difference, in fact, between the two in terms of the South African yield. So it doesn't really matter. But the long-term yield here of the government bond, if you look here from around about 2004-5 to today, is this line here in the 8% kind of region. All right, so we're going to use that number as a risk-free rate. And the theory is, if you buy government bonds from the government of South Africa, is that you will get your money back. And hence, that makes it risk-free. Okay, now there's all sorts of gremlins behind that risk-free and what it means. And I'm not going to go into the detail of that conversation. That's for another time. Just to note where it comes from at this stage. Okay, so we're using the 20-year government bond. All right, let's get that guy out of the way. The next thing we need is this thing called a market premium, which is effectively the extra risk that an investor takes for investing in the stock market. So how do we know the risk premium is 10%? Well, I'm going to bring into picture here a graph that you have also seen before. And this one is our all-share index returns over the last 40 years. And I told you about this cumulative average growth rate of 18%, which is the average return for the market over this time period. All right, so now, if 18% is the average return for the market and 8% is the average return for the risk-free rate, well, that would make the market premium 10%, which is the difference between the two. Okay. Now the beta for the stock market as a whole is 1, and 1 implies risk neutral, if you want. When we look at individual stocks, then we will go and say, well, what is the beta for this specific stock? And we'll come to that in a moment. Let's do a quick calculation here. Here is the CAPM formula. KE is the terminology for cost of equity, equals the risk-free rate plus beta times the market premium. And I've just plugged in these numbers here. Risk-free rate plus 10% times 1, obviously 10%, and we come out to 18% as a cost of equity. Makes sense. That's the conversation we've been having when we talk about the all-share index. It's the average expectation of return of the market. Now, if we want to redo these calculations, and let's do them over here, where a company has a beta of 1.2. Let's change that, and we want to make sure that our formulas tab is on automatic so that our goodie updates. And what this has done is it said the beta of this stock is more volatile than the beta of the market. Now that language is not right. We would say that this stock is more volatile than the market because it's 1.2, it's higher than 1, and the 0.2 represents, let's say, the 20% increase in the volatility. We could do calculations on beta, but that's something you would do at a higher level, not in the specific introductory class. So for now, just know that a higher beta implies higher volatility. High volatility is a proxy for more risk in the business. And if there's more risk in the business, then a shareholder is typically going to want a higher return. We could do the same calculation here for a company that has a beta of 0.8. In other words, historically, it's less volatile than the market, implying it's less risky, and therefore we might use a cost of equity of 16%. All right. Typically, I have found that mining companies have higher betas and retail companies have lower betas. So that's some examples of higher risk and lower risk, if you want. Very rough and ready as an input for calculating the cost of equity using the CAPM. Okay, so it's important that you have this data because we're going to do some exercises and examples where we're going to need to calculate these specific cost of equity components. All right. So that's it on CAPM for now, and we will see you on the far post.